2008, it was a terrible year for long-only managers, and January has proved to be just as painful. So is there a bottom, and how will we know when we hit it? Well, joining us now, Charles Nenner. He is the executive director of Charles Nenner Research Center. Charles, in November you said the Dow would rise as high as perhaps 10,000 in early 2009. You still sticking? First of all, welcome to the program. Are you still sticking with Dow 10,000 sometime early 2009?
In November, I said that we saw a bottom over there. Till now, that was actually the low. It was based on the fact that we would see some signs of reflation. Now, if you look at commodity charts, and for instance, the chart I brought with me, the commodity Goldman Sachs Commodity Index, you see that the low has been made in November. I don't expect to see a lot of reflation, but the deflation scare will go away for a couple of months. Now, the secondary low is right now in the stock market. So for the first time since December 2007, we started to buy. We expect the market to rally into the middle of March. And then I expect another bad situation, and the market will sell off again. So I expect for 3 months or 2.5 months to have some peace and quiet and some hope in financial markets.
But you think it'd be a false hope?
I think it's a false hope. It happened twice in big crises. It happened in the 1900s, 1907, there was a big crisis. In 1933, there was a big rally, only followed by more depression. I think we're in the same situation. We're going to have some hope, a little bit signs of less deflation, a little bit buying in the market, and then getting ready for a sell-off again.
Tell me a little bit, we can back up, because I know that one of the things that you look at in your work is you use the term cycles, that there are cycles and patterns that you're able to discern using really just prices, and you're able to kind of use that to determine what is going to happen next. Explain a little bit about why the whole concept of cycles is so important.
Actually, the question that people have to ask themselves, do markets move at random or not? If they move at random, you have experts that come on the whole day on television and say, well, this could happen, the package could pass, the package should not get passed, we don't really know, nobody knows. If it doesn't move at random, then you look for patterns. And I have proven that there are very fixed patterns and cycles. That means there is a certain amount of months, weeks, days from high to high and from low to low. Now, that high or that low doesn't always correspond with reality. It can correspond with interpretation of reality. So at a cycle low, the public becomes more positive. And at a cycle top, they come up with anything that could be negative. And they make their own reality.
So, in fact, I think last time you were here, this was during the bailout crisis having to do with the automobile makers, and you made the point that the first attempt at the bailout package, it had nothing to do really with what was going on in the automobile industry. It took its cue from what was happening in the stock market. It was almost a reversal. Why or what do you can you offer an example now as to how that is playing out in the current market environment?
Well, we have a question about the bailout package or not. Now, just the anticipation of a bailout package is the same anticipation as will the Fed lower rates or not in the early days when it was still important. Now, if the market thought they're going to lower rates, the market went up, and could be followed by reality that decide not to do anything about rates, but just the impression that people had that they're going to lower rates already was enough. This means the reality is not even important, the anticipation of reality is important. Now, and this is the basis for my cycles, which partly are psychological cycles. If I may, I'll give you one example. Let's say you own IBM, and IBM goes up for a year, and IBM comes out with a great number. Now, if the cycles are up, IBM goes up, and the next day in the Wall Street Journal, you will read investors poured into IBM, it was doing great. If the cycles go down, it means IBM goes down. The numbers were still great, and the next day the Wall Street Journal will say investors took profit because they don't think IBM can do better next year. And the reality was the same, it's just the interpretation of reality.
So the idea is then, and as part of your work, to sort of distinguish between what is reality and what is the impression of reality, and then how you follow people's decisions based on it.
But it starts often with impression of reality, and then followed by the reality people make themselves. So if people have impression that there's deflation, they wait with buying goods, which means there's going to be deflation.
They think the price is going to go down.
Right. So the reality comes after the impression they have. And if they have impression deflation's over, let's buy because now we get a good deal, then the reality is different because now they're going to buy.
Tell me what you're looking at in terms of impressions and reality when it comes to, let's say, the oil price right now. Everyone focused on $40 a barrel oil. People want to know, is it going to go lower? Is it going to go higher? What is your sense of the impression and the reality?
Well, the impression all has to do with China. Everybody's watching China. The impression is going to China, are they going to make it or not? Or are they going to break down like everybody?
Hard landing or a soft landing.
So that's an impression because nobody really has all the numbers. So if people have the impression that China is going to make it, that brings a bottom in the oil price. And if they think they're not going to make it, doesn't make an oil price. Now the cycles show that in about 2 weeks, 3 weeks, we have an interesting low in place. So I don't know what China is going to make or not, but I know that the low is going to be in place for a very nice rally in the crude oil market.
And this is based completely on just looking at price patterns?
Just the price patterns, right.
And when you look at the price patterns, is there anything that ever comes into those patterns that negates the work?
No. You will never see in my work, I've done this now for 20 years, 12 years for Goldman Sachs. You will never see me this and this happened, and because of that the analysis was wrong.
So it's just based on the price movement, which is just people expressing a desire to either buy or sell.
Yeah, and this is what's going to happen. And later we'll read in the newspapers in a week or 2 weeks why it happened.
But it already did.
It already did. That's the main thing.
All right. Well, we already had our conversation. Unfortunately, we ran out of time, but we look forward to having you back. And as you said, a rally into the springtime.
Right.
And then
followed by a new sell-off.
All right. We're going to have to watch that, and we hope to have you back before then. Thank you very much, Charles Nenner from Charles Nenner Research.